Have you ever thought about how the rich seem to get richer while everyone else is in debt? How do they know how to make borrowing money a tool for success instead of a burden? In this video, we'll look at some of the interesting ways that rich people use debt to make and grow their wealth. Would you like to know about these powerful strategies? Debt, often perceived as a burden, is wielded by the wealthy as a powerful tool to grow and preserve their fortunes. While the average person may associate debt with credit card bills, student loans or mortgages, the rich view it as a strategic asset. They employ debt to generate income, expand businesses, and minimize tax liabilities. This sophisticated use of borrowed money is not about reckless spending, but deliberate financial engineering. Understanding good debt versus bad debt. The first step in understanding how the wealthy use debt is to distinguish between good debt and bad debt. Bad debt is often incurred to purchase depreciating assets or non-essentials, such as high-interest credit cards or car loans. This type of debt drains wealth over time. Good debt, on the other hand, is used to acquire assets that appreciate or generate income. Examples include real estate investments, business loans, or financing for education that leads to high-earning careers. The wealthy focus almost exclusively on good debt, viewing it as a tool to amplify their earning potential. For instance, a wealthy investor might take out a low-interest mortgage to purchase rental properties. Leveraging debt for investment growth. One of the most common ways the rich manipulate debt is through leveraging. Leveraging involves using borrowed funds to invest in assets that are expected to yield higher returns than the cost of the debt itself. By doing so, the wealthy magnify their investment potential without tying up their own capital. For example, an investor might use a $1 million loan at a 4% interest rate to invest in stocks or real estate, with an expected annual return of 8%. Even after repaying the interest, the investor nets a 4% profit, which they would not have achieved without leveraging debt. Real estate, the wealth multiplier. Real estate is one of the most popular avenues through which the rich use debt to create wealth. Real estate investments often require substantial upfront capital, which the wealthy frequently finance through loans. By doing so, they can acquire multiple properties simultaneously, diversifying their portfolios and increasing their income streams. Consider the concept of equity build-up. When the wealthy finance real estate purchases with debt, they gradually pay off the principal loan amount using rental income. Over time, as property values appreciate, the owner's equity increases significantly, even though much of the purchase was initially funded with borrowed money. Business expansion through debt. Entrepreneurs and business owners often rely on debt to scale their operations. Rather than diluting their ownership by seeking equity investment, the wealthy frequently use loans to fund expansion. Debt allows them to retain full control of their businesses while accessing the capital needed for growth. For example, a business owner might take out a loan to open a new location, invest in equipment, or hire additional staff. If the expansion generates higher profits than the cost of the debt, the business grows in value, and the loan becomes a tool for wealth creation. The ability to access and manage business debt effectively is one of the reasons why wealthy entrepreneurs can scale their enterprises faster than smaller players. Tax optimization using debt. One of the most sophisticated ways the wealthy manipulate debt is to minimize their tax liabilities. Debt creates opportunities for tax deductions and income reclassification that can significantly reduce what they owe to the government. For instance, interest payments on certain types of loans, such as mortgages, student loans, and business loans, are tax deductible. This allows the wealthy to lower their taxable income while continuing to grow their assets. Another strategy is the borrow-to-spend approach. Instead of liquidating investments to cover living expenses, which would trigger capital gains taxes, the wealthy often borrow against their assets. For example, a billionaire might take out a low-interest loan secured by their stock portfolio. The borrowed money is not considered taxable income, allowing them to maintain their lifestyle without increasing their tax burden. Meanwhile, their investments continue to grow, using debt to hedge against inflation. Inflation erodes the purchasing power of money over time, but the wealthy use debt as a hedge against this phenomenon. When inflation rises, the value of money decreases, making fixed-rate debt less expensive in real terms. For example, if an investor secures a 30-year mortgage at a low fixed interest rate, the amount they owe remains constant even as inflation increases. Over time, the real value of the debt diminishes, while the asset purchased, such as a property, appreciates in value. This ability to lock in cheap debt during low-interest periods is a powerful wealth-building tool. The wealthy often anticipate economic cycles and strategically borrow when interest rates are favorable, ensuring that their debt works for them in the long term. The role of financial literacy and access. A significant factor enabling the rich to manipulate debt effectively is their superior financial literacy and access to resources. Wealthy individuals often work with financial advisors, tax planners, and legal experts to design debt strategies that align with their wealth-building goals. Access to favorable lending terms is another advantage. High net worth individuals typically qualify for lower interest rates and larger loans due to their strong credit histories and collateral. This gives them an edge over the average borrower, who may face stricter terms and higher costs. The snowball effect. Debt amplifying wealth. The wealthy use debt to create a snowball effect, where borrowed money generates returns that can be reinvested to create even more wealth. This compounding effect is a cornerstone of their financial strategy. For example, an investor might use a home equity line of credit, HELOC, to fund a down payment on an investment property. The rental income from the property is then used to repay the HELOC. Once the initial debt is cleared, the investor can repeat the process, gradually building a portfolio of income-generating assets. This cycle of borrowing, investing, and reinvesting allows the wealthy to grow their assets exponentially over time, far outpacing those who rely solely on earned income to build wealth. Risks and criticisms of debt manipulation. While the wealthy excel at using debt strategically, this approach is not without risks. Market downturns, interest rate hikes, or unexpected financial disruptions can threaten even the most well-planned debt strategies. For example, over-leveraged real estate investors faced significant losses during the 2008 financial crisis when property values plummeted. Debt manipulation by the wealthy also faces criticism for perpetuating inequality. Tax loopholes and access to cheap capital are privileges that the average person cannot easily replicate, leading to a widening wealth gap. Policymakers have debated whether reforms are needed to create a more equitable financial system. For the average individual, adopting some of these strategies, such as focusing on good debt, investing in appreciating assets, and improving financial literacy, can help build a stronger financial foundation. While the resources of the ultra-wealthy may not be accessible to everyone, the principles behind their use of debt offer valuable lessons in wealth creation. If you want to uncover more secrets about building wealth and mastering your finances, don't forget to hit that subscribe button and turn on notifications. Join us on this journey to financial freedom.